Stocks tumbled today amid the uncertainty in Iran, marking the fifth consecutive week of declines. It's the longest stretch of weekly losses in nearly 4 years. The Dow Jones closed the day down nearly 800 points, falling into correction territory. That means it's down more than 10% from a recent peak. The Nasdaq is down nearly 460 points, and the S&P 500 is down more than 100 points. It comes a day after markets suffered their worst drop since the beginning of the war with Iran, February 28th. Investors are worried by rising crude oil prices, conflicting messages from U.S. and Iranian leaders, and a dip in U.S. consumer confidence. And CBS News business contributor Javier David joins us now. He's also a business editor for the Dallas Morning News. Javier, thanks for coming on. Good to see you. What does this investor pessimism and stock market plummet mean for the overall economy?
Yeah, look, it's often said that Wall Street isn't the economy, but investors hate uncertainty and turbulence, and so do consumers. So until now, investors were really pricing in kind of a swift resolution of this crisis, and that's why the sell-off hasn't been as deep as we saw last year, the Liberation Day tariff sell-off. But we're now at the stage where markets and companies are really bracing themselves for conflict that stretches into the spring, maybe even the summer. It's why crude prices have been spiking, and it's having an immediate impact on everything from gas to plane tickets to consumer sentiment, which this week hit its lowest in 3 months, mainly on affordability frustrations. Oil is at the highest it's been in nearly 4 years. Some people are bracing for $150 a barrel. So what we have now is this real toxic brew of global conflict, slowing growth, higher inflation, and very pessimistic consumers who are already unhappy about everything and might start pulling back, and indeed, in some cases, already have. And in all possibility, rate cuts that we thought were on the table are now off the table because price pressures are just not cooperating.
You know, one of the things that's created a lot of this volatility is, of course, centered around the Strait of Hormuz, a major shipping lane in the region. As we noted earlier, President Trump has extended his deadline for Iran to reopen the strait or face new attacks. Are U.S. oil and gas prices expected to remain elevated until the strait is open?
Absolutely. The strait's the thing. It's still functionally closed. The president, has hinted at this de-escalation, and it's injected a lot of volatility, but the bombs are still flying. Hormuz traffic is at a standstill. In late February, there were over 100 vessels per day passing through that waterway. As of right now to this week, that number had dwindled into the single digits. So this is a choke point for about 20 million barrels a day of crude and refined products. It's like about a fifth of global consumption. Believe it or not, Asia's suffering even more than we are at this point. But all of that said, to the extent that we have these high gas prices, that translates into higher gas prices. So we're already trending higher because of seasonal reasons. So a sustained move above $100 or more is putting increasing pressure on gas prices toward $4 per gallon or even higher. And it's a tax on consumers when everyone is upset about affordability.
Piggybacking off of the global supply chain here, how is the war impacting the housing market and mortgages?
Look, we were kind of hoping that rate cuts would pull down longer term rates, and that's just not happening. The 10-year yield is inching toward 4.5%. And here's the rub. We really haven't scratched the surface of how bad and massive the U.S. fiscal deficits are. It's injecting a lot of risk into government bond markets. It's making yields do very bad things. We don't have enough time to get into that tonight. But the practical import is bond yields, which influence everything from credit card APRs, loan rates, and yes, mortgages, are moving in the wrong direction, and that's up. And so to the extent that you have the fiscal deficit making bond investors demand a higher premium to hold government debt, and because of geopolitics and domestic problems, it's just riskier, especially as the fallout from the Iran war continues. So the good news is we're not at 8%. We were near 8% in October 2023. Until the war started, rates had been gradually declining. But, at the end of the day, you have rates that are too high. It's leading to scarcity of new buyers. And, now you have this war, and that's a deterrent from new activity. And all of that means is that there's little incentive for current homeowners to get a place. And the ones that already have mortgages, they're not going to unload them because they're locked in at 3 or 4%.
So many economic ripple effects here. Javier David, thank you so much for your time. I appreciate it.
Absolutely.